Over 7 years, 45 of the world's top investors were given between $25 million and $150 million to invest by fund manager Lee Freeman-Shor. He had just one rule: only invest in the 10 best ideas to make money. The Art of Execution: How the World's Best Investors Get It Wrong But Still Make Money maps his findings. Lee joins me now. Lee, first of all, where are your major discoveries?
The guys that have been really successful for me have certain habits that they sort of religiously apply when they're losing or winning. So they're very disciplined in what they do.
Well, as you say, you've characterised investors into these different traits like rabbits, assassins, that sort of thing. So talk me through the different traits people have and what are the ones they really want to have if they're going to be successful.
Before you invest, I think you've got to have a plan of action and decide what you're going to do when you find yourself in a losing situation or a winning situation. When you're losing, you'll turn into one of three characters. Basically, most people turn into rabbits. He ends up doing nothing, ends up in a hole that he can't get out of. And sort of doing nothing or doing too little when you're losing is something you really don't want to do. Most people find it hard to walk away from a high conviction idea that they've lost money in, particularly if we're in an information vacuum where they're sort of sitting there, they can't really understand why the share price is down 20, 30, 40%. They don't know what to do. You've really got to turn into either an assassin or a hunter. And that will depend on more or less your personality, really, what's emotionally easier for you, because an assassin, as the name alludes to, means you've got to ruthlessly cut your losing positions, and that's quite hard to do if you still believe in the idea. And a hunter does the exact opposite, where the hunter basically has a conviction to stay with his idea. But the key thing with being a hunter is you have to materially adapt. So we're not talking, just pound cost averaging, throwing a bit more money every month in an idea. There's a certain point when a stock is down by a certain level where you really need to back up the truck and invest significantly more in that idea if you want the hope of turning a losing situation into a winning situation.
Well, give me an example of this in action, of how some of these traits got it wrong. Let's look at Veidt Communications, which is an example in your book. What did they do wrong when it came to this?
A horror story, Veidt. It was a learning experience and what not to do. And that was really a case study in basically investing in something that was a relatively small cap, so you have liquidity issues. Liquidity, one of the 5 golden rules at the end of the book I allude to is always make sure there's enough liquidity to execute an idea. So Veidt, always had that issue. But when this idea was losing, the investor literally did nothing, and he rode it down a long way. And the problem with riding it down a long way is, the compounding effect. The geometric rate of return means you really are messing yourself over. I mean, if you're down 50%, you need 100% to go back up. In Veidt's case, I think that went down over 90%. So, you need over 900% to get back to where you were. And that's why there's certain points in where you have to decide to do something before you dig a hole that deep.
So you identified this investor as a rabbit. So I know hindsight, it's all very easy to say, what should he have done better? But what should he have done?
Before he invested, had a plan of action whereby if this thing goes against me, what am I going to do? And basically he should have done something. I mean, in the book I sort of suggest you do something between down 20 to 35% seems to be the optimal point to do something from avoiding being whipsawed, as well as the compounding effect and the geometric return effect. And that's what he was going to do. He should have known at outset, either get out completely or invest significantly more. Obviously, in that specific example, he was really impacted by the fact that liquidity was an issue as well. So I would argue, if you do face liquidity considerations, it could be hard to buy significantly more shares in an idea, which means, again, going back to initial position sizing, you probably want a lot less idea if you think you're going to stick with it if it goes against you.
Now, you identified that the best investors do make mistakes, but they still make money,
yep,
as the title of your book says. So how do they do this?
45 of the world's top investors, some pretty legendary, and it's it's worse than a toss of a coin. It's 49% probability of whether their idea will make money. So what really does matter is how they execute the idea. Having a disciplined habit of execution when you're losing and when you're winning is key. I think all investors should go into an idea thinking, I'm going to be wrong. What am I going to do to get myself out of that hole and still make money? When you're winning, it's equally important to be a connoisseur and not a raider, which is the other character trait of what you've got to be. Because if you look at the returns of all the investors I've worked with, all the great guys that have delivered outstanding returns all have one thing in common: they all have the presence of a few big winners. A lot of the losing guys, a lot of the investors I've worked with that weren't successful, tend to snatch at profits. They're what are called raiders, basically. You know, they'll make 20%, they'll take that profit, they'll feel really good, and they'll rotate that capital into another idea. Generally speaking, my findings show that's a really bad idea. You're cutting off the right tail all the time, you don't get any big winners. For that to really work, you need to have a very high hit rate. Again, my findings suggest a hit rate's a toss of a coin. And given the fact you are going to get a few bombs, ideas that go against you just out of the blue, a profit warning or something, you know, you really need to have an approach where you can win big in an idea.